In this video, I'll be going through two of the problems that you have in Connect. The other exercises in your Connect assignment relate very closely to these two problems. First problem ties to problem 11-1, and here we're calculating the depreciation, one based on a straight line, one based on double declining, which is double straight line. I just presented the data here, except I changed the depreciation expense to $11,000 rather than $10,000. Otherwise, the rest of the data is the same. I listed the assets given, and I just calculated the book value as the difference between cost and accumulated depreciation. This is very similar to the problems that were demonstrated in class and in the video. And then we have a straight line, book value under the straight line method of, as I said, it's $160,000. Life of the asset is 18 years. Number of years of depreciation is 4. So I took all this information and I created this table because it's helpful to see, especially under double declining, the calculation of the rate times the ever declining balance. So for 2018, we started with the $200,000 cost. We multiplied it by 11%. So 11% would be 1/18 times 2, double declining. So 1/18 would be straight line, and then times 2 is double straight line or double declining balance. And that comes out to 11%. And then we multiply that by the $200,000, and for the first year we wind up with $22,000. I took the $200,000 and netted against it the $22,000 depreciation expense, and therefore we have a book value at year end of $178,000. We're going to bring that $178,000 back to the next row under 2019 as the beginning balance. And then we'll multiply that by the same rate. And we have a slightly different depreciation expense, a lower one, because we're applying 11% against a declining balance. And then we update the balance by taking the 178 less than 19,580 using my numbers. And we wind up with 158,420. We bring that over to 2020 and we just repeat this process. Once we're done calculating all our depreciation expenses, we just add them together. And that would give us our total depreciation. However, in 2021, the total depreciation is strictly the final beginning balance of 149,994 times 11%, or 15,509. And that is the calculation then for part 1. The second part asks us to calculate the depreciation, but in this case it says assume company B switches depreciation methods in 2021 from straight line to double declining. Whenever you change the methods, you really need to calculate what the book value is at the time of the change. So in this case, in 2021, I'm going to add together the book value under the straight line method to the depreciation expense, which in my case is $11,000. So I'm going to add those two together, and then essentially I'm taking the 171,000 times 13.17%. Now, how do we get the 13.17%? Well, if we have 15 years remaining on the life of this asset, we'll just take 1/15 times 2. And that's what I did. I calculated here, 1/15 times 2. And that gave me a rate of 13.71% times 171,000. Gives total depreciation expense of 22,527. And then we just record the journal entry we've done before, which is debit depreciation expense for 22,527 and credit accumulated depreciation for 22,527. And that's the journal entry then. The point of part 2, I think, is to know that when you change depreciation methods, you need to calculate, first of all, the book value at the time of the change. And this is that they're saying in this case, they're switching as of the beginning of 2021. And so we need to calculate that updated book value and then also consider only the years remaining. as our depreciation calculation to determine our rate. Once you do that, then going forward, you'll continue to decline this balance every year for the next 15 years. Problem number 2, there's 2 parts to this. I just entered the data given for the plan asset land value, and then any accumulated depreciation as of the beginning of the year. In the off-shaded cells, I did change the values, some of these values. However, many of the values I did not change, which results in the actual answers. And then indeed, toward the bottom second part where we're calculating depreciation expense, I did even list some of the check figures for you for this second problem. And so let's just run through the first part. Again, just reproduce the data given in the problem in Connect. Nothing new there. I did make some changes. And then we have these events that occurred. And for the first event, we have a plant facility consisting of land that was acquired in exchange for 25,000 shares. I changed it to 26,000 shares at $50 per. Well, if we paid $1.3 million using my numbers for the fair market value of the land and the building, we need to parse out or separate or bifurcate the values of the land and the building because we do not depreciate land. We only depreciate the building portion of this purchase. So then how do we allocate the 1.3 million altered data between the land and the building? We do so based on assessed valuation. All right, so in this case, if we look at the land, what I did is I just took the 187.5 assessed value of the land divided by the sum or the total assessed value, which is 187.5 plus 562.5. And then that fraction is multiplied by the 1.3 million. So 1.3 million times 187.5 divided by the sum of 187.5 and 562.5 will give me the amount of the 1.3 million to allocate to the land, and I just repeated that process for the cost of the building. If you add the two together, you should have 1.3 million. Another way, of course, to calculate the value, the fair market value of the land from the 1.3 million total is just to take the 1.3 million less the 325 that I already calculated for the land. In either event, you'll arrive at 975 using my altered data. All right, and so I just can reproduce the data that was given. Nothing very substantial in the cost of land improvements, except I changed the value a little bit. When we get down to the cost of the equipment, please note that the cost of the equipment includes the purchase price, delivery, and installation costs. So I listed the total cost at $385, which is the sum of $325, $10, and $50. So that is your total cost on the equipment. To reproduce the values and just do some intermediary calculations on the other data that's given, cost of the automobile, accumulated depreciation on the truck at the date of the sale. I just included that intermediary calculation here. Number of months the truck was depreciated was 9, and depreciation expense for the 9 months was $26.50. Had a book value of $24,000. I'm reading down part F. This kind of information that relates to the depreciation will be needed for the second part of this problem, but not for the first part. All I did then for part 1 is I just took the beginning balance of each of these assets, and then I added or deducted any increases or decreases that were given to us. So in part 1, we do not consider depreciation or amortization in the calculations when we determine the changes in the balances. We're just ignoring them, including the beginning balance. So we're even ignoring the accumulated depreciation for beginning balance in part 1. So let's look at land. Land, we started at $175,000. That was given to us. We had a $325 increase in the land. Remember that $325 was calculated up here when we allocated the fair market value based on the assessed value, and we just add the two together. Buildings, $1.5 million, and if I scroll up again, we see the $1.5 million is given here, just given data. Again, we're ignoring depreciation in part 1. And then they tell us also for the buildings that we had a 975 increase, and that's given here. Allocated fair market value, allocated fair market value based on the 975, which was calculated as the assessed value fraction multiplied by the fair market value or purchase price. All right, so we have, using my numbers, an increase of 975. You'll have a different number, of course. And then I add the two together. What I started with, ignoring depreciation, and my increase, ignoring depreciation. And my ending balance is, using my altered data, is 2475. And I just repeated this process for the rest of the assets. Just take what was given to me, and then the increases or decreases that were calculated or given to me. As well as, in this case, we have some decreases. They tell us, for example, that they sold $17,000. So if you look down at part G, as in good, you see that equipment with a cost of $17,000 was actually scrapped. So then we just will record that as a gross deduction, because that's all they're really looking for, the gross values in part 1. Same thing with the automobiles and trucks. I'm just going to take the beginning, which is given, any additions of, in this case, we purchased an auto in part E, as in Edward. We purchased a new auto for $12,500, so we'll add that in. And then we lost $24,000 on the truck in part F, because that was sold. We sold a truck for that had a cost of $24,000. So again, we're ignoring depreciation in this part. In part 1 is strictly the increases and decreases added to or deducted from the beginning balance. Now in part 2, the last part of this problem, here we do have to consider more of the data that's given to us. And this part is probably maybe the more challenging part of this entire assignment. That is, and not conceptually so much, it's just that we need to kind of carefully interpret what the authors are telling us in the problem. That maybe is the greatest challenge. The calculations are pretty straightforward. So I did give some check figures here, and because of my altered data, some of the altered data, my values are going to be different. But these check figures are the actual values, and I've given you a few more as well, a few more values that are actual throughout my calculations here. Again, just look back to see which data was altered and if it affected the answer. But I did call out these three in particular. Before we proceed any further, I just want to take a look at these notes down here. Because when you're calculating depreciation expense, if it's a function of the remaining life of the asset, then you would use the book value. So if you're calculating depreciation expense and you're either changing depreciation methods or it's based on an ever-declining balance, then if it's always based, or if it's based on whatever life is left of the asset, then you start with the book value and depreciate from there. That is, cost less accumulated depreciation. However, if you're just repeating a previous calculation like in straight line, then you would take the cost of the asset and then divide it by the number of years total of its life. So essentially you'd be repeating the same journal entry every year under straight line. So you'll notice in some of the calculations in part 2 that it's based on the remaining life, like the declining balance method. We're applying the rate against an ever-changing and declining balance. And so in that case, we would consider the book value when we calculate the depreciation expense. But if we are, I guess as I said earlier, if we're not changing our depreciation method, or we're not using an accelerated method like declining balance, then we'll just use the cost, less salvage value if there is any, and there is none in this problem. And then we'll just repeat that depreciation expense each year. So I just wanted to call out that difference, because you'll notice in some of my calculations and the author's calculations, in some cases they depreciate based on the cost. Some cases they depreciate based on the changing balance or the final balance for the previous year. And again, the reasons I mentioned that for them doing that is because of a changing accounting method, changing balance because of the accelerated declining balance, and so forth. So land. If you look at land, there is no depreciation on land, so there's nothing to enter there. If you look at the buildings, in this case, you'll notice in the problem that they tell us that buildings are 150% declining balance. It's accelerated. So our book value at the beginning of the year is going to be the cost less the accumulated depreciation to that point. And it's from there that we're going to start to further depreciate at 6% in this case. So that's what we start with, 1,171,000, because depreciation expense is based on an ever-declining balance. So we need to update the book value. Once we do that, then we need to determine the rate on the building. And they're depreciating the building at 150%. So I took the 150% times 1 divided by 25-year life of the asset. So 1/25 would be straight line, and then I multiply that by 1.5. And we're going to see that we started with a balance of $1.5 million, but then we have to deduct the accumulated depreciation of $328,900. So when we're calculating the building depreciation, we do need to net out the accumulated depreciation to that point as at the beginning of the year. And why do we need to do that? Because if you'll notice for buildings, the depreciation method used is 150% of straight line, and that's based on a declining balance. Well, if it's based on a declining balance, then we need to deduct the accumulated depreciation. So we have this updated book value of 1.171 million, and then we apply that against the 6% rate, and the 6% rate will be 1 divided by 25 times 150%. 1 divided by the life of 25 years, that's straight line. Then we multiply it by 150%. That's the accelerated declining balance. And so in this case, we're going to take 6% of the 1,171,000. Then we have an increase in the buildings of 975,000, which was calculated above. That 975,000 will also be multiplied by 6%. So we're going to essentially be depreciating the beginning balance for the whole year, and we're going to be depreciating the improvement or the increase of 975 at 6%, and add the two together. When you do that, you arrive at 128,766. And that's a calculation then for the depreciation expense on the building. Moving down to equipment. Equipment, as we look in the book, it's based on, and in the Connect, it's based on straight line. So if it's based on straight line, it isn't based on a changing balance. So we can use the original cost, and since there is no salvage value in this problem, we'll just take the original cost of 1,125,000 and then depreciate it at 10%, which is 1/10. So that will give us part of our depreciation expense, 10% of 1,125,000. However, with equipment, we had a purchase of 325,000. We have to depreciate that too. That purchase of additional equipment occurred on July 1st. So when we look at the calculation, we really have two parts to the equipment. 10% of 1.125 million for the entire year. And then since we purchased the new equipment of $325,000 at July 1st, we only have the 6 months of depreciation on that asset. So we'll take 10% times 325,000 and then times 6/12. And we'll add that product to the 10% of the 1.125 million, and that'll give us our total depreciation for the year of 131,750. And when you look at autos and trucks, well, the first thing we need to look at is the depreciation method, and the depreciation method is 150% of straight line. So here we do have to consider the beginning balance in our calculation for depreciation. I've taken 172,000 less the accumulated depreciation because it's based on a declining balance. And that's the book value that I use, 71,675, that I begin the depreciation process. Depreciation rate itself is going to be 150% of the amount of 1 divided by 5, because they tell us that the assets are depreciated over 5 years, so it's 1/5 times 1.5. So 20% times 1.5 is 30%. So that's my depreciation rate. So now I have the updated beginning balance based on book value, cost less the accumulated depreciation, times the 30%, 150% straight line. Now, when we look at the calculation itself, there's been some activity throughout the year on the automobiles and trucks. So let's kind of walk through this calculation a little bit. One of the things, as I said, we need to do is we need to take the 71,675 times the 30%. And that's the first part of our depreciation calculation. However, if you notice, we added value of $12,500, and that is for the purchase of the new automobile. And so that's in part E. We have a new automobile purchased for $12,500, and you'll notice it was purchased on August, end of August, according to Connect. Your text has September, but the Connect problem uses August. So we're going to use August in our calculation. That would leave 4 months left of depreciation, right? September, October, November, December. So we've got 4/12 times the 30% times the 12,500. That's the second component of our depreciation for the autos and trucks. Okay, so again, just to recap, we're almost done with this, and we have one more element of depreciation to include. There are 3 of them. Again, 30% of 71,675 plus 30% of 12,500, the new car, times 4/12, because we bought it end of August. Then we have a third component of depreciation for autos and trucks. And that one is given to us as a depreciation expense for the 9 months ended, which is $2,650. So that is just given to us. That's a depreciation for the cost of the truck. So we're going to have to add that depreciation in too. So there are really 3 components of depreciation for automobiles and trucks to get to our $21,878, which is the actual value you need to arrive at. Leasehold improvements, nothing interesting here. We started with a balance of $230 using my altered data, and then we had accumulated depreciation. Normally we wouldn't have to net these two together as our starting point when we're using straight line. However, in this case, for leasehold improvements, you'll notice that, and the 122 is just the difference between 230 and 108, cost less accumulated depreciation using my altered data. However, in this case, they tell us that the lease was renewed, and it was renewed during the year. And so essentially we have another 5 years. We have 4 years new plus this year. Because we're essentially resetting the calculation for depreciation of leasehold improvements, it's like a change in estimate essentially, we do need to net out the accumulated depreciation from the beginning balance. Because yes, the problem says it's straight line. Because we are resetting the calculation, because we're renewing the lease for another 4 years, and we have to include the current year of 2021, that's 5 years. Whenever you recalculate, as I said earlier, you maybe change an estimate, declining balance method. Whenever you make any of those changes to your depreciation, amortization, or schedule, or your depreciation schedule, what you need to do is you need to take the book value and start fresh. So what we did is took the cost using my altered data less the accumulated depreciation. So I arrived at 122 using my numbers. I've got 5 years of depreciation left this current year plus the renewal of 4. 1 divided by 5 is 20%. 20% of 122, the book value, cost less accumulated depreciation at the beginning of the year, gives 24,400 using my numbers. The actual number you will arrive at is 21,600 because this 122,000 using my altered data will actually be 108,000. So if I change this to 108,000, it changes to 21.6, which is your answer. And then back to my altered data. All right, so that just kind of demonstrates a little nuance with leasehold improvements, that yes, there were no acquisitions. There was a change in estimate because we renewed the lease for 4 years, and then we had to account for the current year of 5, so 1/5 straight line. So that's kind of like I said, kind of an interesting part to the leasehold improvements. For land improvements, finally the last component, no beginning balance, but we did have an increase in land improvements, and this is part B as in boy of your problem, where we had new parking lots, streets, and sidewalks that were required. Estimated useful life of 12 years. I changed the 192 to 200. My depreciation rate will be 1/12 straight line, 1 divided by the 12-year life. And I just multiplied the 1/12, 8.33%, times 200,000, the altered value. You have 192. And then I multiplied that by 9/12, because in part B it says that these improvements, these land improvements, were acquired on March 25th. So 3 months into the year. So we only have 9 months left. So we can depreciate on a straight line basis for 9 months. So 200,000 altered data times 1/12, or 8.33%, times the remaining of the year that we can depreciate, which is 9 months, or 9/12. And you wind up with my altered data answer of 12,500. You'll have a slightly different answer. Just follow the method, though, that I just described, and you'll arrive at the correct answer. All right, so I did call out a few of the check figures. There are others within the blue cells as I went through. But that is the recap and review of the 2 problems, the more challenging ones that you had in the Connect assignment, which will also provide support for you for the other exercises in Connect. And please let me know if you have any questions on this assignment.